Hello, and welcome to our presentation. Today we'll be discussing a practical framework for managing AI-driven risk across a mid-sized bank. AI investment is surging, but fewer than 10% of Gen AI pilots generate positive returns. That disconnect creates 6 simultaneous risk clusters for our bank. The problem is these risks don't take turns. Rather, they cascade through the same balance sheet at the same time, through market, credit, and liquidity channels, making sequential risk management challenging. To evaluate, we consider 3 scenarios. Our final response to manage AI risk is a 3-part framework: identify, mitigate, and monitor, with distributed ownership, pre-assigned instruments, and 3 KRI tripwires designed to force escalation before losses materialize. Let's get started by talking about these 6 overarching risk clusters.
Let me walk you through how we identify these risks. We started broad, mapping every risk the AI boom creates for a bank like ours. We then clustered them by what actually drives them. So 6 clusters came out of that, and they matter because they don't just exist in isolation, they interact with each other. So first, we have the valuation bubble and credit concentration, which hit us through the market channel. Equity repricing and spread widening flow straight into our trading books and loan valuations. Secondly, we have energy and grid constraints and operation and model failures, which hit us through the credit channel. They squeeze borrower cash flows and concentration into those sectors, turning them into default risk. Lastly, we have cyber incidents and climate change and regulation pressure, which operate through the liquidity channel. They can trigger capital actions or freeze wholesale funding faster than any hedge can respond. And the heat map tells you the stakes of this. Corporate lending is red on 4 of 6 risks. There's no part of this bank that sits safely out of the picture. And these are not 6 separate risks. There are 6 simultaneous paths that lead to the same balance sheets, and that is exactly the problem that the next slide shows. Because when you put all 6 risks onto one diagram and trace how they move through the system, something important becomes clear. At the top, 6 root causes. Each one triggers a first-order shock in financial markets. Credit spread widens, equities sell off, energy prices spike, hidden leverage unwinds. Those shocks then reach our balance sheets. And here's the key point. They arrive at different speeds. The valuation correction might hit in days. Energy constraints build over months. Regulatory tightening plays out over years. That means by the time the slower risks materialize, the fast ones have already moved the market, so you cannot address them one at a time. And they all kind of converge into the same 2 outcomes: capital erosion and liquidity stress. Look at the feedback arrows between them. When capital is eroded, wholesale funding dries up faster, which then deepens the stress further. That loop is what turns a bad quarter into a crisis. So the conventional playbook says here to identify your risks, prioritize, and then respond in sequence. This cascade shows why that fails here, and the 6 transition paths show that there's 3 different speeds that all lead into one balance sheet. That is the framework we used to build our scenarios analysis, and I'll now hand it over to walk you through the first one.
In Scenario 1, we analyze a macro-ledger repricing case over a 3 to 5 year horizon. Our narrative focuses on the decomposing of optimistic AI growth expectation and the actual enterprise profitability, placing us currently in the manual phase of the bubble model. To translate this narrative into financial impact, we explore 3 key variables. First is the AI setup PE ratio, where in the risk case it will correlate from the high current level to the lower 10-year average, directly devalue technical collateral and reduce the bank credit portfolio quality. We also use AI profit margin as a proxy for repaying capability. Drop below 10% signal fair monetization, transforming corporate liquidity stress into bank credit risk due to rising default. Finally, credit spread quantified market fair, where systematic buy lead to bond losses and limiting hedging capacity, all of which will change the bank's risk profile. While the best case offers an opportunity to expand demand for corporate lending, but in the worst case, our corporate lending and treasury function face severe credit erosion that forced the bank to boost the capacity reserve to cover project losses. By identifying this trigger earlier, the bank can move from reactive monitoring to proactive risk ownership, adjusting the collateral requirement before the bubble bursts.
Our second scenario evaluates the possibility of an energy constraint and/or a grid bottleneck, as demand driven by data centers could outpace energy generation and grid buildout. Our best case is essentially business as usual. Infrastructure buildout aligns with demand, power prices remain stable, and green financing opportunities grow. In the base case, grid friction drives a 20 to 40% increase in power prices, compressing margins for businesses we lend to and widening spreads in the utility sector. In the worst case, a crisis trigger sees energy prices grow over 40%, which leads to projects being abandoned and concentrated credit losses crystallizing in our lending book. Looking across the bank, corporate lending and sustainability are the two departments that bear the most risk. This is due to potential concentrated losses in our tech and data center lending book, and because rising energy prices reinforce fossil fuel reliance, making our ESG commitments materially harder to deliver. However, we do see an opportunity here. This constraint illuminates demand for greater grid infrastructure, meaning transmission and storage projects are a potential area for lending and investment, where the bank can capture upside while peers manage the downside.
Our third scenario involves a cyber incident. As banks rely more on AI and third-party providers, they increase exposure to attacks that can disrupt core fronts like payments, fraud detection, and customer service. In the base case, a targeted breach disrupts controls, creates delays, increases fraud losses and compliance costs. Now, in the best case, the attack is caught early, systems recover in time, and the impact is limited. However, in the worst case, a major vendor or system is compromised, causing prolonged outage, operational disruptions, and possibly regulatory intervention. The key variables we focus on are third-party provider concentration, recovery time for critical services, and the failure rate of fraud or model controls. Now, looking across the bank's functions, corporate lending and sustainability are the most exposed fronts, while treasury and payments will also be affected if disruption starts to create liquidity or confidence issues. There also lies an opportunity with the bank to gain competitive edge by strengthening governance and response times.
To compare the three scenarios, we look across 5 dimensions: speed of onset, primary exposure, opportunity to hedge, systemic spillover, and opportunity. Looking at these, some common themes emerge. Valuation repricing could happen quickly and would affect the entire bank and economy broadly, systematically. Energy constraints, on the other hand, would likely become clear over the course of multiple years, but there are limited opportunities to hedge that risk. Finally, a cyber incident is unsurprisingly the least forgiving scenario. There is little the bank can do besides invest in cybersecurity to match the growing threat of AI-related cyber attacks.
By utilizing the revised 3 lines of defense model, we move away from a strictly sequential logic of ownership towards shared accountability. When we look across the risks, corporate lending and payments in digital carry most of the first-line responsibility. And this makes sense because corporate lending is on the front line of our AI sector and data center exposure, while payments in digital own the operational and cyber risk that comes with an increasingly AI-embedded infrastructure. On the second line, we assign significant responsibility to Treasury and ALM and trading. Their value here is market visibility because they can observe credit spreads, power price volatility, and regulatory shifts in real time and use that to challenge the assumptions that business lines are making. For governing bodies, most root causes sit with risk committees. These would verify that the controls that the first and second line of defense have put in place are actually working. For AI risks where failures can be silent and slow-moving at first, independent verification is necessary. And one thing worth highlighting is that we've placed AI in the core operations with the board directly, because we think automation decisions are essential questions for the business, not ones to be delegated, and that level of accountability needs to sit at the top of the organization. The broader thread here is that AI risk is hard to isolate, and nearly every function in the bank is touched, and these risks interact in ways that make siloed ownership genuinely dangerous.
And now for the instruments that could be used to manage the CXI AI-related risk. These should be aligned with 4 core strategies: transfer, reduction, avoidance, and retention. The valuation bubble risk should be managed through equity derivatives and redust exposure. Credit and concentration risk could be mitigated via diversification supported by CDS. Energy and grid risk should be addressed through hedging and redust exposure to power-sensitive borrowers. Operational and model risk should be managed through controls, validation, and oversight with partial retention. Cyber and third party could be mitigated through vendor controls and cyber insurance. And finally, climate and regulatory risk should be addressed by shifting to lower carbon assets and selective avoidance. Where risks cannot be fully mitigated, they should be retained and closely monitored using key risk indicators. Such early warning signals could be the HHI index for AI loan concentration, CDX iTrack spreads for early credit stress signals, and CVSS scores to flag critical vendor vulnerabilities, each with predefined thresholds that trigger automatic escalation.
AI is no longer just a firm-level credit risk. It has evolved into a systemic contagion risk driven by endogenous interdependence. Through circular financing, inflated valuations, and fear of missing out-driven capital, a single shock, whether a sentimental shift, an NVIDIA supply disruption, or a TCI collapse, can cascade across the entire ecosystem. Critically, banks are not just exposed as lenders, they risk becoming transmitters of systemic risk, especially when all institutions rely on the same AI models for decision-making. This is why we must move beyond traditional credit hedging towards systemic systemic stress testing, scenario planning, and early warning indicators.